Ellerston Capital is an Australian-based boutique investment manager with over 5 billion Australian dollars in funds under management. The company is majority owned by staff with over 30 investment professionals and 8 individual strategies. The benchmark for the market neutral fund is the RBA cash rate, and the compensation for the market neutral team is directly linked to the outperformance of the fund over that benchmark. Typically, portfolio managers have a large investment in their own fund also. So the fund has 2 investment objectives. The first is to preserve the capital of the fund, and the second is to generate a return, a net return to investors of 5% over the RBA cash rate over rolling 3-year periods. So the investment philosophy is relatively simple. It's to exploit some of the inefficiencies that occur in the Australian market. The inefficiencies in the Australian market come about because of some of the concentration issues within Australia. And there are 3 primary concentration issues that we think we can exploit in managing the funds. The first one is the funds management industry is very concentrated. 50% of the equity funds under management are managed by the top 10 managers. The second is the primary index that most of these managers are measured against is extremely concentrated. Almost 70% of the index is in 20 names. And the third issue in the Australian market is the majority of the products are long only. Very little funds are able to short, hence the amount of participants on the short side is lower, and there are inefficiencies that we can capitalise on by being able to short sell. So the fund uses 2 strategies in achieving its investment objectives. The first is relative value, which accounts for 80% of the gross exposure since inception, and the balance, the 20%, comes from special situations. Relative value is a strategy where we look to capitalise on inefficiencies between 2 similar stocks, typically that are in the same sector. Special situations looks for trades or positions where we think there is a low probability of losing money and a known catalyst for realising the position. So positions for relative value are selected in a very defined way, and there are 3 key parts to the process. The first is we identify those situations where there's been a dislocation in performance between 2 very similar stocks. The second part of the process is where we apply a qualitative filter and we look to identify those pairs where there has been some fundamental news or data that's caused that dislocation in performance. And the third part of the process is we get our investment analysts to assess the relative value merit of each of those positions before they become part of our portfolio. Special situations are those positions where we think there's a low probability of generating a negative return and we have a known catalyst for realising the position. Whereas relative value pairs focuses on the ASX 200, special situations can be drawn for a much broader universe, and hence we use the broader Ellerston group in identifying those. What we look for are situations where there is a mispricing opportunity between the current price and where we think we can realise that investment at some point in the future. So examples of special situations may be an IPO, a placement, a buyback, those type of transactions. Some of the key characteristics of a market neutral strategy include no or little to no net equity exposure, a modest or low correlation with equity markets, little or no capital drawdown, and then volatility that's much lower than the equity market or other traditional asset classes. So the fund relies on volatility. So if we're in a period where there is low or very little volatility, the fund may struggle to achieve its return objectives. The fund also uses leverage, so there are associated risks with using leverage, and they would be appropriate for the fund. The fund also engages in short selling, and so there are additional risks that you won't find in a long-only product. And typically these type of funds are built around one or two individuals, so there is more key man risk typically in these type of funds when compared with a more traditional product. Some of the benefits include low correlation with traditional investments, diversifying the risk and return of the overall portfolio. Most market neutral funds can generate positive returns in a rising or falling market, so that will also help manage the overall portfolio. And again, market neutral funds typically have a focus on capital preservation, so this will help manage the overall capital of the balanced portfolio.